Assalamualaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Ardan Imam Rashid, and today I'm gonna talk about financial ratio formula and calculation. Without further ado, let's straight to the point. If you are studying accounting, then how to analyze financial ratio is an important thing to know. This analysis will always be used in the business world, especially investment and management. Investors usually calculate and analyze the company's financial ratio to see the size of the investment opportunity to be invested. So how to analyze it? Let's see more here. What is financial ratio analysis? Financial ratio analysis is an effort made to measure the financial situation in a company or a business. The way to analyze financial ratio is by using data from financial statement to make comparison. In accounting, financial ratio analysis is usually done at the end of a company period in 1 year. This financial ratio analysis is generally used to determine strategies for future company or business planning. In addition to internal needs, financial ratio analysis can also be used as a way to show the performance of a company or business to investors. Through this analysis, it is hoped that the potential feasibility of obtaining investment or funds will be seen. Next, types of financial ratio. How to analyze this financial ratio can be determined by the type you want to look at. Below are some types of financial ratio. The first, solvency ratio. The solvency ratio is used to determine the effectiveness of the company in using its asset or wealth. The way to analyze financial ratio with this type is as follows. Debt ratio. The way to calculate the debt ratio is to divide the amount of debt by the total asset of the company or business. This calculation can provide information about the amount of asset of a company or business to see how much of the asset are financed by debt. The lower the percentage, the better. Here is the formula. Debt ratio equal total debt total asset is 100%. Debt ratio. Debt ratio. With capital approach, the way to analyze financial ratio in this type is to divide the amount of debt by the amount of capital. The smaller the resulting percentage, the healthier in the finance of a company or business. This means that the debt on does not exceed the capital. Here is the calculation formula. Debt ratio equal total debt total capital x 100%. The second, liquidity ratio. Liquidity ratio is a type of calculation used to see the liquidity capability of a company. The calculation takes into account current asset. Current ratio. The calculation of the current ratio is to divide current asset by current debt. The percentage of the result can provide information about the company's ability to pay current liability in a short period of time. Here's how to analyze financial ratio of this type. Current ratio equal current asset, current debt x 100%. Current debt. Here are some types of liquidity ratio. Cash ratio. The way to calculate this type of financial ratio is to add up cash and cash equivalent and asset. Then divide the result by current debt. If the result is close to 100%, the better for the company or business. Here is the calculation formula. Cash ratio equal cash plus cash equivalent asset, current debt x 100%. Next, quick ratio. The quick ratio is the result of the difference between current asset and inventory, which is then divided by current debt. The percentage can show the financial health of a company or business. The closer to 100%, the better. Here's how to calculate this type of financial ratio. Quick ratio equal current asset mean inventory, current debt x 100%. 3. The third activity ratio. Ratio are used to see the productivity of asset owned in a company or business. There are several types of activity ratio, namely inventory turnover ratio. The inventory turnover ratio is used to determine the liquidity of the company. The higher the resulting ratio, the better the inventory management. Here's how to calculate it. Inventory turnover ratio equals cost of goods sold inventory. Next, receivable turnover ratio. The accounts receivable turnover ratio is used to determine the amount of receivable of a company or business. The greater the accounts receivable turnover, the better for the company's finance. Here is how to analyze this financial ratio of this type. Receivable turnover ratio equal total receivable average receivable. Fixed asset turnover ratio. This ratio shows the company's ability to generate sales using fixed asset. The greater the ratio, the better the finance of the company or business. The way to calculate this type of financial ratio is as follows. Fixed asset turnover ratio equals sales fixed asset. Total asset turnover ratio. The way to calculate this ratio is to compare sales with the amount or total asset of the company. Total asset consists of current asset and fixed asset. The bigger the ratio, the better. Here's how to calculate it. Total asset turnover ratio equals sales total asset. Profitability ratio. Profitability ratio are used to calculate the profit of a company or business. This ratio calculation can be used in the following types. Gross profit margin ratio. This type of ratio is used to determine the ratio between gross profit and sales. The greater the ratio result, the better the company's finance.